In this teaching tip, we'll look at the capsim rubric report. Now, as you know, a rubric is a set of criteria that can be used for evaluation purposes. In the context of a business simulation, the criteria should include performance ratios and other indicators of competent management. For example, are the production lines running efficiently? Is the company's market share above average? Do the product's offerings meet customer demands? Now, the capsim rubric scores criteria on a scale of 0 to 3, 0 being terrible and 3 being excellent. The rubric is organized by team. A quick scan will give you a clear idea of what's going right and what isn't for any given round. So let's take a look at it. Log into the website. On your class page, click Industry Results, then Debrief, then Rubric Debrief. Now, this rubric is from round 3 of a random simulation. I've glanced at the front page of the Courier, and I know there's a pretty big gap between the sales leader, Ferris, which is closing in on $200 million, and the worst performer, Andrews, which is under $90 million. Now, we know Andrews is not well managed. The rubric will quickly show us the core issues. Let's start with the company rubric. The product rubric displays below. We'll look at that in a moment. Under margins of profitability, the team scored a 2 out of a possible 12. No surprise there. Their sales were just $87 million, but they did score a 2 out of a possible 3 for contribution margin. So there's hope. Their ability to raise capital, 4 points out of a possible 9. Their leverage, which we define as assets over equity, scores a 2. Sound fiscal policies. Now, Andrews did not take an emergency loan, so they scored a 3 in this category. Again, the leverage is adequate. Just 1 for the current ratio. Now, the current ratio, which is current assets over current liabilities, this indicates their current assets are largely funded by borrowing. The bankers are getting a little worried. The Capstone Debrief Rubric report explains this and other criteria in detail. The keys available from the rubric table of contents. Plant purchases funded. Andrews scores a 3. A quick glance at the Courier's cash flow statement survey shows they spent $40 million more last year than in the previous year, and they found the means to pay for it. Now, on the Courier report, if we view the production information on page 4, we see 2 new production lines for products that will come out early in the upcoming year. More hope. Back on the rubric, under forecasting, more good news. We see Andrews got a 3 for actual versus potential demand. Now, this means that overall, they had sufficient inventory to meet customer demand. But they only scored a 1 for stockouts. 1 point equates to 2 products stocking out. So, which 2? We find our answer on page 4 of the Courier. Adam and F stocked out. It's round 3, so there's time enough for Andrews to turn things around. We're looking for other issues that Andrews can address. And the rubric's competitive advantage area tells us that Andrews should beef up its marketing and its R&D efforts. A quick scan to the product section confirms this. The scores are consistently low. Let's compare Andrews' product scores with its competitor, Ferris. Well, here's something in common. Products for both teams score poorly in the price percentile. The difference, Ferris is persuading customers to buy their high-price sensors, and Andrews is not. They're doing this with a combination of superior products, note the scores for positioning and age, and aggressive marketing, as indicated by the promo and sales scores. Now, this is why Ferris has sales approaching $200 million. So here's an example where a low score, in this case price percentile, can be a positive. Continuing with Ferris, we see a 0 for inventory reserves. They've run out of some products, but a 2 for bloated inventories. On page 4 of the Courier, we see several stockouts, but 2 products have 6-figure inventories. 0 for reserves, and a point deduction for 750,000 units still on the shelf. Ferris's product offer gives it a distinct advantage, as shown by other scores. Digby's product score is well or better than Ferris's, and its sales are almost equal, but Ferris is far more profitable, and the rubric tells us why. Digby scored a 0 for margins and profitability, and Ferris scored a 12. Digby's contribution margin did not allow it to cover its operating expenses. Well, that's it. A quick scan of the rubric report will give you a roadmap for any debrief, showing you company performance on the management and product levels. 3s are good, 0s are bad.